Walk into any bank branch on a Tuesday afternoon and you'll find two people sitting in nearly identical chairs, filling out nearly identical mortgage applications for the same house on the same street. Same asking price, same down payment, same loan amounts. One of them gets up, shakes the banker's hand, and walks out paying $2,004 a month. The other one shakes the same banker's hand and walks out paying $2,163 a month. They nod at each other in the parking lot. Neither of them knows what just happened. Over 30 years, that $159 monthly gap costs the second guy $57,240 more for the exact same house, the exact same neighborhood, the exact same life, and that's just the mortgage. Before they're done, the full gap between these two people in insurance premiums, car loan interest, deposits, and credit card rewards they'll never see will quietly approach $400,000. Not because one earned more, not because one was smarter or luckier, because one had a 3-digit number, the other one didn't, and the bank never stopped to explain this to either of them. My name is Nick, and I spend way too much time thinking about money that moves from people's pockets to lenders and insurers without anyone explaining the transaction. If you've ever checked your score, seen something like 710 or 730 and thought, yeah, that's fine. This video is specifically for you because fine is costing you a fortune. Let's run the actual numbers. Before we get into the money, let's establish what we're actually talking about, because there's a lot of confusion around credit scores, and most of it comes from being told that anything above 700 means you're doing great. Spoiler, 700 is not great. 700 is fine. There's a significant difference between fine and exceptional, and that difference has a dollar amount attached to it. The FICO scale runs 300 to 850, broken into 5 tiers: poor, fair, good, very good, and exceptional. 800 to 850. Exceptional is what they call you when you've spent a decade doing everything right, and the bank rewards you with a slightly lower number on a loan you still have to pay back for 30 years. The financial system's love language is discounts on debt, but we work with what we've got. Here's what most people don't realize. 800 and 850 are functionally identical to lenders. Nothing is reserved for 850 that isn't equally available at 832. Once you clear 800, you've unlocked everything. The journey from 800 to 850 is basically a vanity project. So how rare is 832? The average American FICO score is 715. The median is 744. Only about 23 to 24% of Americans carry 800 or above, roughly 1 in 4 adults. And 832 sits well above that floor, somewhere in the 93rd to 95th percentile. Only 5 to 8% of scored Americans are at or above this number. For context, a perfect 850 is held by about 1.76% of consumers, 4 million people out of 250 million scored adults. What makes the distribution uncomfortable is this. The national credit picture is splitting into a K-shape. The middle range, 600 to 749, shrank from 38% of consumers in 2021 to 34% by 2025, while both the top and bottom tiers grew. Americans are clustering at the extremes. The gap between those who benefit from excellent credit and those penalized for poor credit isn't staying the same. It's widening. Let me give you a person to think about. We'll call him David. David is 31, pays his bills on time, has a couple of cards he doesn't max out, and carries a 714 credit score. He genuinely believes that's solid, and it is fine. The 58th percentile, the comfortable middle of the American credit landscape. Fine is also, as we're about to see, quietly expensive in ways David has never once been shown a bill for. So before we go further, hold on to this. 13 out of every 14 Americans are leaving money on the table right now without realizing it. We're about to find out exactly how much. And the mortgage number alone is going to bother you. This is where a high credit score does its heaviest lifting. Using 2026 data, here's what a $320,000 mortgage, 20% down on a $400,000 home, Costs across credit tiers on a 30-year fixed. An 832 score gets you approximately 6.41% APR. Monthly payment, $2,004. Total interest over 30 years, $401,000. A 700 score gets around 6.63%. Monthly payment, $2,050. That's only $46 more per month, until you run it out 30 years and realize you've paid $17,000 more on the exact same house. A 680 score is paying about 6.80%. Monthly payment, $2,087. Total interest, $431,000. That's $30,000 more than the 832 buyer. And at 620, technically fair credit above the FHA threshold, you're paying around 7.15%. Monthly payment, $2,163. Total interest, $458,000. That's $57,240 more than the 832 borrower for the exact same house, same yard, same neighborhood, same everything. The only variable is the credit score, $57,240 for the same house. That's a car, that's a year of private school tuition, that's enough to make a reasonable person sit in a bank parking lot and question all of their decisions. And the banker who handed both of them their paperwork went home and slept fine. Now, before you think $57,000 sounds significant but survivable, now let me reframe it. That's $159 extra per month for 360 months. If instead you invested that $159 at 6% annual returns, it compounds to approximately $181,000 over those same 30 years. The real cost of a 620 versus an 832 on a single home isn't $57,000. It's closer to $250,000 in wealth you'll never build on one home, and most Americans buy 3 to 4 homes over their lifetime. You can feel a little ill now. That's a normal reaction. David buys that house with his 714. His rate is 6.63%. He's paying $46 more per month than the 832 borrower and thinks he got a great deal. He has no idea he's financing the lender's next bonus. Now, if you think the mortgage is the whole story, the next few minutes are going to be worse, because the mortgage is the part people have at least heard about. What they don't know is the insurance industry quietly charging a credit tax every single year on something that has nothing to do with your ability to drive a car. But first, cars. Say you're buying a $35,000 vehicle financing over 60 months. With an 832 score, super prime in lender language, your rate is around 4.66%. Total interest, roughly $4,300. A 700 score pays about 6.50% interest. Total interest, $6,100. A 620 score pays around 9.50%. Total interest, $9,100. The 832 buyer saves $4,800 on a single car versus the 620 buyer. Over 6 to 8 vehicles in a lifetime, that's $28,000 to $40,000 in savings from car loans alone. But here's where it shifts from a lending problem to a full spectrum financial penalty, because the credit score gap doesn't just hit you when you borrow. It follows you into transactions where you're not borrowing anything at all. In 47 out of 50 states, insurance companies are legally allowed to charge you more based on your credit score. Not your driving record, your credit score. California, Hawaii, and Massachusetts looked at this and said, absolutely not. The other 47 states said, sure, sounds great. So if you live in one of those 47, you're paying a credit tax on top of your car payment and nobody sent you a memo. A driver with exceptional credit pays an average of $1,673 per year for auto insurance. A driver with very poor credit pays $6,254 per year. Same driver, same car, same record, same commute. The only variable is the credit score. The difference, $4,581 a year, $381 every single month for driving the same roads. David is paying about $2,400 a year for insurance. He thinks that's normal. It is normal for 714. His neighbor with an 832 pays $1,673. David is handing over $727 extra a year for having a lower number. It comes out of his account monthly and feels like the cost of driving. Over 40 years, that gap is more than $64,000 in extra premiums before a single investment return is factored in. And this is before homeowners insurance. Same system. Before utility deposits, because yes, your electric company and phone carrier check your credit too. With an 832, those deposits vanish. With a 620, you're handing over $200 to $750 up front before you've turned on a single light. The total lifetime cost of poor credit versus exceptional credit, researchers put it at $397,652, nearly $400,000. That's 9.4 years of median full-time pay. It bleeds out quietly, month by month, in slightly higher payments that feel normal because they've always been this way. Now let's talk about what actually changes when you hit 832, because it isn't just the rates. It's the texture of every financial option available to you. Premium credit cards, the Amex Platinum, Chase Sapphire Reserve, Capital One Venture X. These exist in a completely different universe from secured cards and 29% APR products. Sign-up bonuses worth $1,000 to $2,500. Cashback rates of 2 to 5%. Airport lounge access, travel insurance. The average 800 plus score holder generates $500 to $2,000 per year in rewards alone. Rewards people with lower scores simply can't access. Lending Tree's analysis of 100,000 consumers with 800 plus scores found their average total credit limit was $73,280. The national average is $30,000. So 800 plus holders have more than twice the credit available, meaning even if they spend the same dollar amount, their utilization stays dramatically lower, which keeps their score high, which keeps their limits growing. The system rewards you for already being in a good position and makes climbing from the middle harder. It's not rigged exactly, but it's very self-reinforcing. There's also the rental market. Landlords in competitive cities get 30 to 50 applications for a single unit. An 832 score doesn't just meet the threshold, it ends the conversation. Your security deposit's waived, sometimes first month free. Meanwhile, the 620 applicant is fighting over the listings nobody else wanted and employment. About 51% of employers in financial services, government contracting, and security cleared positions run credit checks during hiring. A poor credit history doesn't just cost you money. In certain fields, it costs you the job. There's a genuinely impressive amount of wrong advice floating around about credit scores, and some of it has been costing people real money for decades. Myth 1, you need to carry a balance to build credit. This is the most expensive credit myth in existence, passed down across generations with the confidence of established fact. It is completely false. It has always been false. Somewhere out there is the original person who started this, and they have caused millions of Americans to hand free money to credit card companies for absolutely no reason. Whoever you are, not great. What your score actually cares about is that you use credit and pay it, not that you carry a balance and pay interest. Pay your full statement balance every month. Myth 2. Closing old cards you don't use is good hygiene. Closing an old card reduces your available credit, raises your utilization, and shortens your credit history. All three hurt your score. Leave old cards open, put a small recurring charge on them so the issuer doesn't close them for inactivity. That's the entire move. Myth 3, checking your own score hurts it. There are two types of inquiries. Hard inquiries, when a lender pulls your file for a loan, cost around 5 points each. Soft inquiries, when you check your own score, have zero impact. Check it every week if you want. Myth 4, your income affects your score. It doesn't. Income doesn't appear on your credit report. It's not a FICO factor. A person earning $40,000 with disciplined habits routinely outscores someone earning $400,000 who mismanages debt. Credit scores measure behavior, not earnings. Myth 5, and this is the one I want to spend a moment on, 850 is the goal. It isn't. Zero practical difference between 832 and 850. No product, rate, or tier exists that's available to 850 holders, but not 832. The benefits of exceptional credit are fully unlocked around 760 to 800. Everything above that is the financial equivalent of scoring 101 on a test graded out of 100. You can do it. It proves something. It just doesn't get you anything more. One last thing before we move on, and this is a genuine rehook because the next section is where people either act on this information or they don't. We've established what 832 is worth. We've cleared the myths. Now let's talk about what actually moves the number and be honest about which parts you can control and which parts are just time doing its thing. Here's what nobody tells you up front. Most of this is embarrassingly simple. Not easy, simple. Easy would mean it happens fast. Simple means the moves aren't complicated. They just require patience most people don't have because nobody showed them what they were building toward. We've spent 15 minutes establishing what 832 is worth. Now let's talk about how you actually get there. FICO's formula is public. Payment history, 35%. Credit utilization, 30%. Length of history, 15%. Credit mix, 10%. New inquiries, 10%. Payment history and utilization together are 65% of your score. And both are things you can control right now. Getting from 700 to 750 is about elimination, not construction. Drop utilization below 10% by paying your balance before the statement closing date, not just the due date. Set up auto pay on every account. Pull your free credit reports from all 3 bureaus and check for errors. Millions of Americans have inaccurate information dragging their score down, and disputing it costs nothing. Stop applying for new credit. This phase takes 6 to 12 months. It's not exciting, it's infrastructure. This is where the score starts to feel real. Lenders treat you differently. Rate quotes change. You can actually feel the tier shift. Getting from 750 to 800 is optimization plus patience. Push utilization below 7%. The average among 800 plus scores is 5.5%. Diversify your credit mix with an installment loan if you only have cards. Stop opening new accounts. Let existing ones age. One counterintuitive detail, scoring models reward 1% utilization on one card slightly more than 0% across all cards. The system interprets zero utilization everywhere as possibly dormant credit. Leave one card with a tiny balance when the statement closes. This phase, 1 to 3 years, getting from 800 to 832 is almost entirely about time. The average 800 plus score holder has maintained their oldest account for 23.3 years. No shortcut to 23 years exists. Use the AZEO method. All zero except one card at 1 to 3%. All others at 0 when statements close. Keep 8 to 10 open accounts. Never miss a payment. Apply for nothing and wait. You can't hustle your way here. The clock is the main ingredient. The best time to start was 10 years ago. The second best time is right now. One warning, a single missed payment at this level can drop your score 50 to 80 points. At 832, with years of pristine history, missing a payment hits proportionally harder. The model sees a severe deviation from pattern. Autopay is not optional, it's table stakes. One last thing before we close, and this might actually be the most important thing in this entire video, because everything so far has been about getting to 832. What I want to talk about now is what happens after. Because there is a trap on the other side of this achievement that the financial industry has no incentive to warn you about. A high credit score is not the same as financial health. Confusing the two can wreck you just as quietly as having bad credit. When you have an 832, banks offer you enormous loans. Mortgage brokers show you the maximum you qualify for. Credit card companies send high-limit offers with low rates, all genuinely useful. We've spent 15 minutes establishing that. But the system is built to help you borrow more, not to help you decide whether you should. This is the part where someone hits 832, gets approved for a $600,000 mortgage, finances 2 cars, opens 4 premium credit cards, and posts a financial freedom reel on Instagram. Their credit score is exceptional. Their net worth is a rounding error. They've used their excellent credit to build the world's most expensive illusion, and it looks great until one of them loses a job. You can have a perfect 850 credit score and negative net worth. The score measures how well you manage debt, not whether you have wealth. Someone with $1 million in index funds and no credit cards scores lower than someone drowning in a mortgage they're barely keeping up with. The system has no idea who's winning. Real financial health uses the credit score as a tool, not a scoreboard. The goal isn't to borrow as much as possible at the best available rates. It's to have an 832, live below your means, invest aggressively, and occasionally deploy that score to get the best terms on something you've already decided you actually need. The score is the dashboard reading. The wealth is the destination. Don't confuse the two, so there it is, 832. A number most people treat as a score on a report card they barely check, when it's actually a financial instrument that pays out for the rest of your life. On a single home purchase, the difference between 832 and 620 costs $57,000 in extra interest, or $250,000 in foregone wealth when you account for what that money compounds to. Across a lifetime of car loans, another $28,000 to $40,000. Insurance alone, $4,500 more per year, $64,000 over a driving lifetime. The total lifetime cost of poor credit versus exceptional credit approaches $400,000, not from any single failure, from slightly higher rates, slightly higher premiums, slightly worse terms, quietly compounding for decades. And the path there doesn't require a high income, an inheritance, or a finance degree. It requires understanding 5 factors, automating your payments, and having the patience to let time do what only time can do. What it does require is treating your credit score not as a vanity metric, but as the financial infrastructure it actually is. Build it carefully, protect it seriously, use it deliberately, not as an invitation to borrow more than you need, but as a tool that permanently lowers the price of everything you'll ever borrow for. The 832 score doesn't make you wealthy by itself, but it changes the price of everything. And over a lifetime, changing the price of everything adds up to a number that should make every person watching this stop and think about where they sit on that scale right now. David, by the way, still has a 714. He's still fine. He just doesn't know yet what fine costs. Now you do. Drop your score in the comments and tell me what's in the way. I'll see you in the next one.